Hi guys, welcome back to our YouTube channel, AlgoWise. So in the last video, we discussed about the details. We covered some topics: technical analysis, fundamental analysis, what are those, and even quantitative analysis. So today we'll be discussing in detail about fundamental analysis because these topics are itself huge and they take a lot of time. So Molloy would be continuing with his discussion, and he will be elaborating more on this. So yeah, Molloy, please go ahead.
Hi, Kalyan. Yeah.
Thank you.
So you have already given the brief highlights of what we have discussed earlier. So now, since as I told in the earlier video also, these are all very vast subjects. So it is always good to cover them individually. So
Correct.
so okay. So today's point of discussion is then fundamental analysis. So okay. So the what I've told last time as well, I want to emphasize that once more, that for the fundamental analysis you need to monitor the shares periodically. Okay, so every quarters, when the results are announced, you need to see those results, and then you have to analyze whether to stay invested or whether to exit from the share. Okay,
Okay.
so that part of analysis has to be done. So I will show today how to do those kind of analysis, or even if you are trying to make entry into a new share, then whether it makes sense to make an entry at this current position or not. So those things you can understand. There are many screeners available in the market, like Trendline, the screener.in. So we can just pull out one of them and show how to analyze and how to decide on which stock to invest and when to exit. Okay.
Okay.
So let me share my screen for this. So if it's visible, then uh, let us talk about
Uh, 1 second. It has not come up yet. Uh, it's still blank. So you have already shared the screen, right? Your screen.
yeah.
Okay, now I am able to see. Yeah, perfect.
Okay, good. So let's, for example, we can look into the screener in identifying. For example, if we want to look in Infosys. So
Okay.
like the screener.in is this is a site where you will get all the financial data of the company. Okay, so you can search any stock here. Okay. So then there is a provision to export that in the Excel as well, and you
Okay.
get the brief about the company here. What exactly is the company into, in which services or they make products, or all those things are available here. Okay, so you want to understand more about the business. Then there is a table. The first table shows many of the critical parameters, like the market cap of the company, what is the current price, the 52 weeks high and low point, so that you have a sense when we are entering, at what price we are entering, the stock P by E, the book value of the company, dividend yields, return on capital employed, return on equity, then debt to equity ratio. You see the sales growth for the 3 years, profit variation for the 3 years, price to book value, industry P by E, the PEG ratio of the company, returns over the 3 months and 6 months. Okay,
Okay.
so uh, before going further down, there are let me try to explain some of the points why these indicators are, or the ratios are important, and what can we derive from that, right? So the market cap is like the size of the company. Means the market cap is basically the number of free floating shares which are there in the market, multiplied by the market price. So it gives an indication how big the company is, right?
So that does
So
not include
then
the promoter share, right? Or it includes the promoter share.
it includes the free floating shares which can be
Okay.
traded in the
Okay,
market. Okay.
which can be traded in the secondary market. So the free floating shares, not the promoters, maybe 5%, 10% or something like that. Not that.
No. Okay,
Okay.
so then you can see the 52 weeks high and low, that is there, so you can understand at what price it is now, whether it's like at the 52 week high point or low point. The stock P by E is nothing but the price is to earning ratio, and it gives a tentative valuation of the company, because if you see, you have another industry P by E. Okay, so
Mm-hmm.
if the share is way above if the share P by E is way above the industry P by E, that means it is available at an expensive rate. So that if that means that we should not invest in a high P by E share, we can still invest in share which is superseding the industry P by E, but then it has to have a reason, like the growth numbers or the revenue numbers, the net profit and the revenue numbers should be accordingly higher than its peers, right? If it can
Okay.
justify that, then it can justify a high P by E. Okay, so if you see then we have the
So if you can
return on
explain how what exactly is P by E, so I think that will also be better.
Okay, P by is the price to earning ratio. So the price means the current price of the company, and earning of the company, the net profit of the company in crores. Okay, so
Okay.
so the higher is the earning, so the denominator goes up and the P by E shrinks, right?
Correct. Correct.
Or so it's an indication how if the earning is less and the price is more, that means it's an expensive share,
Expensive
right?
stock. Correct.
So P by E typically, if it's low, that it means that it is good, but it's not always true,
Yeah.
because some of the companies which demand high P by E, there is a reason. Maybe the business outlook for the next 5 to 6 years is very good, and maybe the company with a P by E of say 20 can maintain a growth of 30%, like that, both in top line and bottom line. So
Okay.
if that is the case, then it can command for a high P by E. So if
Okay.
this is clear, then the other important terms is like return on equity.
Okay.
Return on equity, basically if you're like investing say 100 rupees in a business. Okay, so and then if it's 29%, then means you are getting, if you're investing 100 rupees from in a business, you are getting 129 rupees.
Correct.
Okay, so
Okay.
that is the return on equity. Why it is important? Because in India scenario, in Indian scenario, so the cost of capital is around 15%. Means if you are investing 100 and if you're getting 115, that implies that you are at a break even point. Actually, you are
Mm.
not making any profit out of the business. But if you are getting anything, a return of equity more than 15%, that means you are actually generating positive cash flow for the company.
So
Okay, so
cost of capital is basically the interest rate at which a business would be taking getting money from the market. So that is the basic it. So if you say commercial and also it will be like 11%, 12%. It obviously it's a range. So that is it, right?
right, so some other factors are taken in, and the thumb
Yeah.
rule is like consider 15%.
Consider,
And
yeah, correct, correct.
any so 15% and above, if we have a return on equity, it is termed as a good number. Okay,
Okay.
so and now then the other important term is that I spoke in the earlier videos, is the debt to equity ratio. The debt to equity ratio, if it's the cash reserves which the company has. Okay, plus the equity value of the company, it sits into the denominator, and you have the depth as a numerator. So the more the depth you have, the ratio would be going up. Okay,
Correct.
so the thumb rule is that if a company is having a zero point 0.5 debt to equity ratio, which means if it has say 5 crore of debt, then it should have equity plus cash reserves of 10 crore. Okay, so that
Okay.
gives a indication that its financial strength is good. It has cash reserves to pay out the debt if required, and if it has sufficient cash reserves to go for future expansion if it's required. Okay,
Okay.
so that's why this term is important. And then we have the sales growth of 3 years and profit variation of 3 years. So why this is important? Because if you see here, the stock PYE is 29, right? So if a stock is commanding a PYE of 29, so it has to have a sales growth nearly in and around that range. Okay, so I would
Mm.
say that if it's having a stock PYE of 29, then it should sales growth for the 3 years should be around, say, 20%,
Okay.
like that. And that's the top line growth. And the bottom line growth, if you see the profit variation here, it is having 12.9, which is 13%. So seeing only these parameters, you can understand that it is running at a high PYE. Or because if I look into the past data, and if the future is not that much in the future, if it cannot grow in such a good rate of the top line and bottom line, then the return from that company can be limited. Okay, so
Okay.
now that we are not analyzing what actually is the future prospect of the company, we are just seeing how to analyze those things and understand what is, if the PYE makes sense or not. Okay,
Okay. Okay. So
then we
basically,
have.
the top line, bottom line is also the top line would be the revenue, so the absolute sales number which you have, and then the bottom line would be the after all deductions, EBITDA, and everything, and then whatever is the net profit number. So that is the bottom line, right, of a balance sheet.
Right, correct.
Okay.
Uh, so bottom line is the actual net profit
Actual net
which the
profit.
company
Yeah. Mm.
which the company reports. So we have a PEG ratio, PEG. So this is PE by the growth ratio. Okay, so the way the company is growing. Okay, so if a company is demanding a high PYE, then as I told, the sales growth numbers are very good. The revenue, the top line and bottom line growths are very good. So that company can command for a high PYE. So when you divide the PYE with the growth of the company, so it becomes PYE PEG ratio. Okay,
EG
so
ratio.
if this
Okay.
ratio, so the growth, if the growth supersedes the PYE, then the number would be less, right?
Less. Yeah.
So
Correct.
for the PEG ratio, any number which is less than 1 is considered to be a good number.
Okay.
Okay. So then you have the returns of 3 months and 6 months, which gives that immediately what has happened to the how it has given returns to the investors, so that you can understand here. Another important term is the change in promoter holding. So here you see that on quarterly basis, these data are updated. Okay. So
Okay.
on every quarter, if the promoters are adding more, if the promoters are adding more because they are the running the business, right? So they would know better, way better than what actually is happening to the company. So if the promoters are selling, they itself they themselves are selling the shares, then it doesn't it's an indication for us that something is wrong in that company, right? And if the promoters are acquiring more shares, then it is good, it gives a comfort for the retail investors that okay, the promoters are buying, that gives a conviction for us to buy as well,
Correct.
right?
Correct. Yeah.
So that's the reason why this is important. uh, then the industry prices to book value is there, and also book value is there. So book value, so prices to book value, the prices to book value is the current price divided by the book value of the company. So if you talk about book value is nothing but if you liquidate the entire company today, so how much cash you can get out of it. Okay, if you sell, if it's like an oil and gas plant, you are selling all the equipments, all the cash you have. So if you liquidate the entire company, so this gives a valuation of say 20 crores. Okay, and if the that is the book value of the company, and if the company price is 100, then the prices to book value becomes 5. Okay, so
Okay.
higher the prices to book value, that means it's an expensive, it's entering into a expensive range. The lower is the prices to book value, that means it is from the valuation perspective, it is good. Okay, so then it's not that every company would have a same prices to book value. It depends upon the industry, because the capital incentive companies where the assets you own are expensive. Like if you are infrastructure company, you need machineries and all, right? So you have to hold assets, so your book value would be more. So if your price is relatively less, so prices to book value should be lower. But for
Okay.
the asset light companies, like in the IT segments, okay, so where you don't need to hold on to the heavy machineries and all, so there the prices to book value is always historically more. So it's a relative term. You have to choose the industry, and you have to see the industry prices to book value to understand whether the share is relatively expensive with respect to the industry. Okay.
Okay. Okay. Okay. So, okay. So out of these terms, so if we see this, yeah, the same page here in Screener. So, which of these terms you think like these are most important out of all the parameters we spoke about? EPS, stock, P, then return on capital employed, everything, book value. So out of these parameters, which if a novice investor or maybe a trader, obviously let's talk about investment. So in that case, if he's looking at these parameters, which one do you think which of these parameters would be most important, to uh, just have a glance at and then analyze something?
Okay, so if I look into the first table, then for me, the market cap is important because it gives me an indication whether this company is small or big. Okay,
Okay.
so whether I'm buying a small cap share, mid cap share, or the large cap share, that is
Okay.
important. Then the price obviously you will find in other places. When you are going to buy, you will going to know that
Correct.
anyway.
Correct.
And the
Yeah.
stock P by E is important for me. The return on equity is important for me. Okay, so and return on capital employed and equity means you are generating the return from equity, but it doesn't take care of if you have taken any debt, whether how much return you are making on that debt as well. So whereas
Oh,
the
okay.
ROCE is a return on capital employed. Capital employed means it covers the equity and also the debt. Okay, so it gives a
Okay.
more holistic view.
Yeah.
So both the numbers are good for this company. That's why it's commanding a high PYE, you can say,
Okay.
because it's like it's way above the industrial standards of say 15 to 16, right?
Okay.
So and then these apart from these two terms, debt to equity ratio is important. And obviously you need to see the sales growth and the profit variation for the 3 years. Okay, and
Okay.
change in promoter holding.
Okay. So that is also important, right? If
That is also important,
mm,
because there are something this is something which you are not analyzing, but you are trying to predict based on promoter behavior, so that is also important. Okay,
okay. Okay.
so for the I think for there are for other things we can discuss, but we have the charts, then we have the peer comparisons,
Correct. Correct.
we can analyze, go through the quarterly results, then we'll see the profit and loss statements,
Correct. Correct.
and
Correct.
then we have the balance sheet, cash flows. Okay, so
Yeah.
shareholding patterns, how FIIDIAs are holding the shares, how much shares is held by public. Okay, so
Okay. Okay.
these things will cover in steps. So
Correct. Correct.
for
I think, yeah.
this,
I think
so
that will be
for
better. So
okay,
this video was mainly to give a glance into the how the fundamental analysis approach should be, and then maybe we can go into the details with. I think we can use the same screener and then discuss more in detail, right? So I think the same thing we can continue in the next video.
okay,
Yeah.
great. Thanks,
So,
Kalyan. Always a
yeah, thanks,
pleasure
Molloy, for
to talk
joining.
with you.
And this was very insightful and very nicely presented. So, we'll discuss in detail in the next video. Yeah.
Sure. Have a good day.
Okay. Yeah. Bye.
Bye.